Hi, everyone. Welcome to a very special episode of In the Money with Amber Kanwar. As you can see, we're not in our home studio. I am in Vancouver with our partners, Raymond James. We are here for their annual National Business Conference. They have 500 investment advisors from around the country, and I am grateful to be sitting with Larry Adam, who's the Chief Investment Officer for Raymond James, and we are going to get into these markets, and he's responsible for overseeing over $1.5 trillion in assets. Let's get into it.
The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions.
Larry, thank you so much for being with me.
Thanks for having me, Amber.
We are very excited to talk to you. It's kind of your job to direct this more than $1.5 trillion in assets. And I'm curious what you think about that job right now, because this has been a bull market that I think has defied a lot of people's expectations.
Well, first of all, I get a lot of help doing that. One of the things is we do have an investment committee where we get a lot of our views. And I have the ability to have 4 different touch points. For example, I get to use our top-down strategist and economist. And they use historical data. They look at history to really see where the markets could go given different scenarios. I then get the ability to look at our research analysts that are actually talking to companies every single day, seeing what's happening on the ground floor of the economy. Then I get to talk with portfolio managers. And I think that's pretty important because they're actually putting their money where their views are on a real-time basis. And then we always, at our meetings, always bring in an external person that's a top tier from another firm. And I actually like when we bring in people that don't have our same views. And that's critical because I never want to have our team with groupthink, kind of just compounding what we think on and on. I want to be challenged to make sure that we're always given the best research, if you will, to our advisors and to our clients.
That's an interesting process. Is that how you think about the role of a CIO? Because I think in each firm it's different. From my lens, I'm just looking at all the strategists and I'm saying I always boil down your job to something so simple. What's their price target? How much upside is there in the S&P 500? Yep.
No, so I've been fortunate. I've had both roles. At my former where I worked before at Deutsche Bank, I had a dual role of both Chief Investment Officer of the Americas and then Chief Investment Strategist. And I think the difference between the strategist and the CIO is that I'm ultimately responsible for communicating the entire view among all the asset classes and the economy to our clients. And that's why I want as many touch points as possible, because I want to make sure that we give as close to reality or at least as accurate as possible to our clients.
I looked at what your target was for the S&P 500, 6,900 for the S&P, is that right?
For September of next year.
For September of next year. I hate to tell you, Larry. You did it. We're basically already there. Oh yeah, what are you going to do now?
No, we're going to stand firm because I do believe in our models. A lot of people say that we're like Zen investors in the sense that we try and strip the emotions from investing. And if you think about it, there's 2 emotions that tend to dictate all decision-making, right? It's fear and greed. I think we're in an environment now where it's panic and euphoria. So you have to strip that away and you always got to rely on the fundamentals. And when it comes to the equity markets, we rely on at least 4 different models. Dividend discount model, a cash flow model, a PE model that really determines what the correct PE should be. And then we do a relative value model of how our equity is priced versus the bond market. And I would tell you that consistently we come right around that 6,900 level. So that would tell you that I'm a little bit more cautious here in the near term. And by the way, that's not really calling for something big because if you think about it, historically in a given year, 4 to 5 times you give a pullback of about 5% or more. And we haven't had one in a long period of time since this rally began in April. So I think we're due for at least a modest bull market correction coming.
So that means the bull market stays intact. We're in year 3 and you think it goes for how many years?
Well, historically, they last about 5.5 years. So if you think about Bon Jovi, I think we're about halfway there, right? So I still think we have...
I hear you're a singer. I might make you sing it.
I can do that one. But no, I think we're about halfway there. And I think the underlying fundamentals are still pretty positive longer term for this equity market.
You know, it's interesting you mentioned kind of the fundamentals and panic euphoria, because one of the things we've been talking about on the podcast is if you read the headlines, if you read what everyone is talking about, you wouldn't then look at the market and say, oh, this is a market at all-time highs, whether it's valuations, whether it's tariffs, whether it's supply chain disruptions. I mean, there's a lot of bad in print and on the airwaves. How do you reconcile that with the market?
Well, again, we rely on the fundamentals. When you look at valuations, to your point, believe it or not, if you look at the S&P 500, it's in the 99th percentile over the last 20 years, which means only 1% of the time has it been more expensive. So to get the equity market higher, you're going to have to get earnings to really drive it higher. And the good news is that I do think that earnings will continue to move higher. We're looking for earnings growth next year, 2026, of 10-11%, which gets us to $292 for the S&P 500. But you bring up a great point, and that is when you look at all these surveys, what people say and what they do are two different things. And I will give you a good example that I look at institutional money managers. And right now, a lot of them, 60%, say that the market is overvalued right now. But if you look at them, a net 45% of global managers are overweight equities. Overweight equities. If you look at their cash holdings, it's at the lowest levels that they've seen in 12 years. So they might be saying one thing, but they're doing another. And I think that's the important thing.
They call that fear of missing out.
Correct. That's absolutely the point. And I think that longer term, though, I don't really know. If I look at what's happening from a fundamental perspective, I think we have the fact that earnings are going to continue to move higher. I look at something called shareholder activity, which is dividends and buybacks. And if you look at dividends, in 10 of the 11 sectors in the S&P 500, dividends have actually increased this year. And when I look at buybacks, it's on the path of over $1 trillion this year. That's an all-time record amount. And I don't really see that changing going into next year. So that's a positive. And then obviously the Fed cutting interest rates. Historically, as long as we avoid a recession, which is what we think is going to happen, I think that that's a positive tailwind for the equity market.
It's not even the Fed cutting rates. I mean, all of a sudden, the world is back to cutting rates again. And I saw this great chart. And this week, I think with the number of rate cuts we're expecting, including from the Fed, we will have absorbed more individual rate cuts than the great financial crisis, just to give a sense, not in terms of where we are in rates, but just the number of cuts that we've seen. It's over 315 now. Is that old adage, don't fight the Fed, like very much alive and well? Don't fight central bankers when they're easing?
So I think don't fight the Fed is an important concept. And I also think don't fight the Fed because we think there's more than just this cut coming up in October. We think the Fed cuts at least 2 more times this year and at least 1 more time next year. And the reason I say at least is because you have to remember there's going to be a change in leadership down at the Fed. And depending on who that person is, there could even be more cuts along the way. And our economists believe that we could actually see interest rates going down to the neutral level, which is somewhere around 3% in the US.
What are we just putting blinders to inflation?
So I actually don't think inflation is as big of a deal.
Tell me why.
I actually think it's going to be transitory. And if you just look at what inflation is doing right now, I think you're going to see it start to tick higher because a lot of those price increases have not gone into effect. I think we're looking ahead, you're going to see some, particularly during this quarter and probably the first quarter. But tariffs are a one-time increase in prices. That's why the Fed's calling it transitory. We agree. And if you look at our forecast, by the time we get to the middle of next year, I think you start to see inflation go lower. A couple of reasons for that. Number one, keep in mind that only 1/3 of inflation is goods, 2/3 is services. So really the 1/3 is the only thing that's really being impacted by the tariffs. If I look at some of the services, one of the biggest part of the services is owner's equivalent rent, shelter prices. 25% of CPI is because of that. We think that those prices are going to continue to move lower as we go into next year. And then I think AI is going to continue to be a tailwind driving inflation lower for years to come.
And we're gonna pick on AI in just a second, but I want to pick up on a point where you said inflation is going to cool down and marry that with you're looking at what people do, not what they say. Another thing that money managers have been doing is allocating to gold. At the time where we've got a risk on rally, we also have a risk off trade, which is buying gold. And so I wonder how you see that. That's a bit of a tension, how you see that playing out if your view is that inflation is going to come down.
So when I look at gold, I told you we're fundamentalists, right? So we need to have numbers to come up with the price target. And right now, gold it's got some fundamentals in silver, and there are some commercial needs for it. But the rally that you've seen up 50, 60, 80% for some of these commodities doesn't really point to fundamental change. So it's become kind of like some of the cryptocurrencies. It's become an asset class of what I would call sediment. So I think part of the increase was because of more demand from central banks, because of more commercial demand, but now it's all sediment. And the reason I know that is that if you look, for example, at the number of ETFs, how many people are buying the ETF, it pretty much correlates with the price of gold. So the point is that if all of a sudden you start to see people not worry as much, it could fall. So we liked gold a while ago, but I don't necessarily think the fundamentals at these current levels are really justified. So we're a little bit more cautious on that gold as it has become more of a sediment indicator as opposed to just being a risk off type of asset class.
Okay, so I'm a little bit cautious on the gold trade. You mentioned AI. I mean, it's the most predicted bubble, potentially bust, but who knows when or if that will be. What's your comfort level with AI right now in terms of how it's showing up in the markets?
Well, first of all, I still think we're very in the early stages of AI. I mean, if you look at the amount of money that's been spent, right, it sounds like a lot, but when you look at it as a percentage of our economy, it's still only around 1.5%. So I don't think it's as extended as people think that it is. I also think of the drivers of AI are the big mega cap tech companies, and they are completely different than what companies were back in 2000.
Let's unpack that. I think it's really important to understand how are they different.
All right, so first of all, let's do macro. Back at this junction of the dot-com age, how many people do you think had access to the internet? 4%
Of the world.
of the world. Today, it's almost 70%. So that just tells you the adoption of new technologies is much faster than it has ever been. When I look at the sustainability of earnings growth, these mega cap tech companies continue to drive consistently higher their earnings. One of the reasons they're able to do that is that if you look at their margins or their profitability, it's more than double what it was back in the late 1990s and 2000, which means they can continue to invest for that next great technology, and they can continue to build moats around their businesses. And probably one of the biggest differences is that tech companies today are not like they were back then. Back in the late 90s, they were one-trick ponies. They had a piece of hardware or a piece of software, and they rode the upgrade cycle over time. Today, you know the big mega cap tech companies. They have hardware, they have software, they have services, they have some exposure to different industries like healthcare, the financial sector. They're much more diversified, so they have multiple levers now to pull.
But at some point, they're going to need to see a return on the trillions that are being poured in. Are you optimistic that that's going to come?
I do. I mean, I think we're going to get a good feeling this week with a lot of them reporting, but I do think that they're making the investments. And by the way, those numbers that you see out there haven't been fully invested yet, right? They're kind of sitting on the side, waiting to be deployed. And I do think that when I look at some of the advances that are taking place, and some of the different abilities that AI can do. And it's not just on the internet. It's just not getting communication like the internet was. This is fundamentally driving how the healthcare space is now, fundamentally driving how the industrial sector is doing. You're seeing very big upticks in what it can actually do going forward. Now, that being said, I will tell you that a lot of these companies, I think you probably saw some of these companies are starting to talk about, if you think about how you do use some of the AI today, what do you notice you don't see on there? Commercials, right?
That's right.
Ads?
Yes, ads.
I think you might start to see some of that start to find its way into it, to start to pay for that type of stuff. But ultimately, I think that more and more people are buying into it. And companies in particular, if you look at all the Gartners of the world and all the big consulting firms, every company is really looking at ways to really, leverage AI.
And if you want exposure to that, I mean, there really is no other market in the world to go to than the US. And, you're here in Canada, we've got our banks, we've got our commodities, we have a little bit of exposure to tech. And obviously commodities, that's been nice exposure because gold price has moved up. But if you're bullish on AI, you just don't really have a choice. The US, the S&P 500 is that index.
The most transformational companies in the tech space are in the S&P 500, and you know the names. And I would actually tell you that if you looked at the S&P 500, it's more than just those names. People will say that the S&P 500 has 35% technology exposure. It's a record amount. It just took out the dot-com age of 34. But I would tell you it's a lot bigger than that. Because if you take the tech sector and add on top of that the communication services sector, that includes names like Meta and Google. If you add on top of that some of the tech companies in the consumer discretionary space, like Amazon, like Tesla, if you include on top of that the fintech companies like MasterCard and Visa, which, by the way, were actually in the technology sector just a few years ago, it's well over 50% at around 54%.
That's kind of wild.
It's become a digital type of index.
You're supposed to go to the NASDAQ for that kind of tech exposure.
Yes.
I feel like people need to go into that with eyes wide open, that a bet on the S&P 500 is a de facto bet on tech.
It is clearly on developed tech.
Tech.
Because I would say that those companies are much more, as you mentioned, they have a global footprint. They have multiple ways to manage their earnings. So these aren't fly-by-night companies. These are all, again, very still mature companies.
The thing that's interesting about that is when you look at other large companies that aren't tech, they're also doing well. And in some cases, they're doing better than some Magnificent Seven names in 2025. Like Apple, Amazon, they haven't actually done anything. There's no return for 2025. And I think that might surprise people because they're still sitting close to those records.
Yes.
They've got huge market caps, but the performance is starting to come elsewhere.
You are starting to see a broadening because, if you looked over the last couple of years, we call Magman, which are the 6 big mega cap tech stocks. We take out Tesla. And what you're seeing is that their earnings growth is starting to come down and it's narrowing to the rest of the market. But I would tell you one of the reasons why we still like technology is that for all of the rest of this year and for the 4 quarters next year, those technology companies are still expected to have the premier growth in the market. But you're right, you are seeing some expansion of that. Companies continue to come in, their earnings are better than expected. But, by the way, saying earnings are coming in better than expected is like saying the sun's going to rise tomorrow, right? I mean, it's a consistent thing. The average beat, if you look back historically, is around 5%, 6%. So again, but you are seeing it. It's not just tech that's doing that. You're starting to see it now in the healthcare space. Last week, you saw it in the financials. They're starting to see a little bit more upside in their earnings.
So you've got the wind at your back from central banks.
Yes.
AI, which you think has got many years to it, at least. And I also want to spend a beat on fiscal policy because I think that was an underappreciated element of the stock market rally during the Biden administration. And I think when people think of government policy right now in the U.S., it's tariffs, right? They're focused on tariffs and what's happening with trade. But there's also a huge bill, the one big, beautiful bill. A lot of those policies, they start to come in effect next year. How do you think about that as a risk-on factor?
Well, it's one of the reasons why we think you're going to see an acceleration in growth in the United States next year. Because like you said, from a consumer perspective, no tax on tips, no tax on overtime. The state and local tax deductions get elevated. There's additional tax credits. So that puts more money into the consumer's pocket to continue to spend. On the corporate side, you have things like 100% immediate depreciation if you invest and do research and development.
Which means you can just write it off. You don't have to stagger it over years.
Exactly.
You make a capital investment, you can just write it off.
And
that's going to materially lower all these companies' tax bill.
And what companies are doing that?
All the big tech companies.
And exactly. So that's why it will continue to foster the growth in that sector. So I think that is a pretty big driver of the economy next year.
Isn't tax on tips so wild? What is a tip? Couldn't a fund manager say that, hey, my performance fee is a tip?
Well, there's limits. My bonus will be a tip, right?
Yeah, that's right. Yeah.
But I do think there are limits to where you can to get that. But I think the combination of that, and here's another thing for next year that I don't think people give enough credit for, is that I call them my intangibles. And I think one of the things that will drive sentiment next year is that if you look in the United States, we, like Canada, are one of the hosts of the World Cup. I think that'll be a positive.
It's a driver of the markets, you think?
The U.S. will have its 250th anniversary next year, and you have the midterm elections. I don't really see how the president or Congress is going to have the U.S. economy show any signs of weakness when you have the global spotlight of the world on the United States next year. So that's another reason why we're pretty comfortable with our growth forecast for next year.
Okay, but we also do have to address tariffs. You addressed it in a way that you think it's just kind of a one-step increase and ultimately inflation goes down. I'd like to talk about it in terms of the market reaction or the lack of the market reaction as we get further and further from Liberation Day, especially, as it stands right now, Canada and the US we're not chatting. We've got some issues, we're not chatting. And there was almost no reaction to that in the markets, kind of like a relatively short term. And I'm curious, because you're having so many conversations with investors, with your peers, like, what is that? Why is the reaction becoming more and more muted?
So I'm going to take two sides of that. Number one of the reasons why I'm cautious in the near term is because I do think that people will start to see some sticker shock during this upcoming quarter, and I think that's going to slow growth down. I also think that those tariffs could potentially start to challenge some of the margins of corporations, because if they can't pass it on to their consumer, then they're going to have to eat some of those costs. And that could lead to some intermittent downward revisions in earnings, and that's why I think you could see some volatility here in the near term. Longer term, one of the reasons why people have kind of changed, they've kind of gone full circle, is that now these tariffs are kind of viewed, as you mentioned, for fiscal stimulus, that they can offset some of the costs that we have down in Washington. And that's why when you look at this IEPA, the International Economic Powers Act, that goes in next week in front of the Supreme Court, right, November 5th. If that gets reversed, meaning that the president cannot use that, and all of a sudden that goes away, those revenues, that could all of a sudden start to see interest rates start to pop up again. Mm-hmm. So that's something to keep an eye on. But longer term, the president has multiple other avenues, whether it's doing sector tariffs, he's got some other ways that he can do it. I think the tariffs are going to be around for the foreseeable future.
How important has it been in your work to understand the strategic priorities of the president and the U.S. administration, maybe more than others? I've been having conversations with people about how the U.S. is shifting from a capitalist model, free market, to a mercantilist market, where, it's kind of government-directed, strategic imperatives. Trade is obviously one. Industries like AI, potentially quantum, taking stakes in Intel, potentially taking stake in lithium companies. Like, these are not things that we have seen in a very long time. What are the conversations you're having about what that means and how that informs your investment outlook?
So I think the president is looking at things that are very important going forward. He's looking at national security. So a lot of these things, for example, with rare earths, right? We've seen they're used in MRI machines, they're used in military, they're used in the semiconductors that make up our phones. They are imperative to anything that we do. And what's been interesting, and one of the things that's been misread out there, is that the U.S. has enough rare earths, metals. The point is we don't manufacture them, right? We ship our rare earth metals overseas to China where they make the magnets. So helping the industry to nurture that industry so that you can make those magnets, which is going to happen now in the United States. A lot of people look at that when they hear that story, they're like, that's actually pretty smart, right? That's looking out for a national priority going forward. If in fact something were to happen with Taiwan, we have to be able to manufacture those chips in the US. So whether it's helping out at Intel, incentivizing some of those other companies to build
Taiwan semiconductors to build in the U.S.
Exactly. I think that's imperative to national security. So I don't necessarily know if people are calling it mercantilism. I think it's a prioritizing of national security is what people are seeing. And I think a lot of people are shocked when they hear that we didn't even have those. Like how, I mean, when did you really hear about?
Because of globalization.
Yes.
It goes to where, it's most efficiently produced. That was what the world was doing for the last 30 years.
No, absolutely. And when you bring up tariffs, I've seen a big change in what people view as people are becoming more educated on that. And a lot of clients I've been talking to, they're like, you know what? A lot of those tariffs were, we didn't put any tariffs, and that was because, and they had tariffs in their countries versus the U.S. But that was like 40, 50 years ago when they were just trying to get their sea legs, but they're still in place. So maybe there was a time period where there's a compromise in the middle. Now, again, the way some of these have been done, arguably, right?
Yeah.
It's, that's why a lot of people think that IEPA will be reversed, because whether it's
Remind us what that is.
So IEPA is the International Economic Powers Act, where it gives the president the authority if the U.S. Has any type of national security issues. And, the commercial in Canada may not be, putting any type of national issues for the U.S. Some of the ones down in like Brazil, if you didn't like the administration, putting it on there, that's not necessarily maybe the real intellectual part of what that law was put in. So, but again, like I said, even if it gets reversed, he'll just find other ways to go about.
I mean, even separate from ideology, with your investor hat on, are you just looking at this and saying, well, he likes it, we should too?
Not necessarily.
Okay.
I'll give you a great example. So everyone made the mistake a couple of years ago. You got to be in the energy in the U.S. when President Trump takes over, right? Because we're going to drill, baby, drill. And what happened? It was the worst performer during his 4 years in office, right? If you think about these rare earths, the more you make in the U.S., right, the price is ultimately going to go down. So while strategically it will be important, I'm not necessarily sure longer term that could be like the best thesis, if you will, in investing.
I think people are tempted to, I know I am, I'm tempted to get cute. I know what's out there. I know the big market caps that are out there, and I think, well, I want to be contrarian. I want to go somewhere where nobody is. And it's hard to find, by the way, a market that hasn't done well. I think people probably feel really smart looking at their portfolio. It was really hard to miss over the last year. But if I think about an area of the market that maybe hasn't kept up as much, it's maybe the smaller caps of the U.S. And so when you think about all the things that you're talking about, fiscal policy, monetary policy, even AI spending, like driving efficiencies, does that trickle down to small caps, or do you still want to be with the agents of those change?
So I agree with, there have been a lot of positive developments for small cap. The fact that the Fed is cutting, and if that stimulates the U.S. economy, that historically has been a positive. The fact that the Fed is cutting, over 50% of small cap companies get their debt from short-term floating rate bonds. So if rates are going lower, that benefits them. And to your point, if you want to be in an area that's not consensus, it's probably small cap, because a lot of institutions are underweight. And by the way, just so you know, it doesn't take a lot of money for small caps to rally. If you added up every single small cap stock in the United States, every single one, it would not be the size of NVIDIA.
Oh my God.
It wouldn't be the size of Microsoft. It wouldn't be the size of Apple, right? That's how small it is.
By the way, that's like 2,000 plus names.
Yeah, exactly. Right, exactly. But we're still neutral on small caps. And the reason for that is that if you go to the fundamentals, in 10 of the last 11 quarters, the earnings growth for small cap stocks have been negative. And that's an environment where the U.S. economy has been robust, and that's an environment where large cap earnings have been very good. Now, so for me, I'd have to see some sustainability in earnings. Now, a lot of people will tell me, Larry, when I look into 2026, once again, those small cap earnings are going to be double digits. Well, I would tell you that that's rinse and repeat. The last 3 years, you've seen earnings revised down for small cap stocks by 10% or more.
So every year we think it's going to be double digit growth.
Exactly.
And then it never is.
So until that optimism turns into reality, we're going to remain neutral on small caps. Now, I will say that small cap, you probably have this question with a lot of your investors, passive versus being more active. Small cap is an area where you definitely want to be an active investor. And the reason for that, we just talked about the Russell 2000, 42% so around 800 stocks don't even have any earnings. So if you just think about that 2,000, if you just take those off, most of them are going to be lower quality companies. You probably have a better chance of outperforming. If you think about uncovering opportunities, you and I are probably not going to uncover an opportunity in large cap, right? If you look at the big cap names that we're talking about, they have anywhere from 50 to 80 of Wall Street's best analysts following those
Like
stocks.
who has an edge on NVIDIA?
Nobody has it, right?
Yeah.
No, everybody knows.
Yeah.
But in small cap, the top 5 biggest small cap names, maybe around 10 analysts follow. As you get smaller, it probably gets closer to maybe 1, 2. So if you can do your homework, that's an area where you can outperform. And the proof has been in the pudding. So I hate throwing a lot of numbers out of you, but
I love it.
But if you went and looked at the Russell 3000, which is the 1,000 biggest companies in the United States, and then the 2,000 is the smallest 2,000. If you looked at the top 100 best performing stocks this year to date, 64 of them are small cap companies.
Oh, wow.
And that's not an anomaly. Last year, 69 of the top 100 were small cap stocks.
It's a real stock picker's market.
So if you do your homework,
Yeah.
it's a stock picker's market in small cap.
It's not an index.
No.
Buy an index right now. So, putting all of this together, you're constructive for the next couple of years. You think those themes are going to take us there. We could be in for some near-term volatility.
Yes.
You're telling me this message, but I know that you take it across the country, the continent, and the world. And I'm curious, what's the biggest pushback that you get? What do people say? Oh, Larry, you're way off base on this.
So most people think that, and this gets back to the optimum, they think we're underestimating the upside of the equity market.
You're too conservative.
Yeah, and you talk about strategists, and I actually think that that's one of the things that makes me most nervous when I start to see strategists leapfrogging, and we're going to get into that environment here pretty soon. The end of the year, when people start to look into next year, you're going to hear 8,000, I'm sure, bantered around 8,500, right? That gets me nervous when everybody's going in the same direction. It gets back to what we were talking about before, because I've been in this business a long time, and when everybody starts thinking the same way, the market will humble you.
What is similar, we talked about the metrics versus the dot-com era, but you mentioned, you've been doing this a long time. What about, your kids would call it, what about the vibes? How are the vibes different from, previous other hype cycles?
So with this one, when you talk about the hype, one of the things that everybody is kind of positioned in the same way. And what I mean by that is that we do a survey every quarter, and it's almost 80% of our clients view technology as one of their favorite sectors, right? And nothing is even close to that. Every other one is below 50%. So that gives you a little bit of flavor of how optimistic. If you look at the University of Michigan, it's like almost a record number of people that think that the market is going to go higher over the next 12 months, right? That type of optimism, and when you look at some of the other things out there, people put the call ratios. If you look at the VIX, the volatility index. And by the way, it's not only in the equity market, it's actually in the fixed income market too. When volatility continues to go lower, when you look at spreads, right, in the bond market, they're like the lowest levels that they've been in decades.
We almost had like a little bit of a freak out in the bond market, and then
Very short-lived.
very short-lived. Do you expect the bond market to remain kind of calm and subdued? Like we talked about your view on equities. How do you think fixed income plays a role in your portfolio right now?
Well, I like the income that bonds are providing now. I mean, if you look back over the last 15 years, you're getting better than what you've gotten in, on average over the last 15 years. I think the 10-year Treasury yield is, when you look at the yield curve, you're going to see the short end go lower, right? So because the Fed's cutting, that's what's impacted. The longer term, I think, is going to be pretty much range bound. And that's not a big secret because it's been doing that now for the last 2 years. For rates to go down materially, I think we'd have to see a recession. For rates to spike, we'd have to see what I would call a buyer spike, where people around the world don't want to buy U.S. bonds. And there have been a lot, and you've talked to these people, I'm sure, that think that 10-year Treasury is going to go to 5%, 6%. Some people out there,
Jamie
7.
Dimon, I'm still waiting for
7%.
6%. Yeah, 6% Treasury yield.
But I just don't see that because I see a lot of people still buying our debt. There might be some truth that China has sold some, but I will tell you, internationally, it's an all-time record high, the amount of bonds that people have bought in the U.S. And the big thing that we watch, again, this may be a little technical, is something called the bid to cover ratio.
Tell me what that
and
is.
you'll hear it on CNBC. So anytime the government comes out with an auction, how much demand is coming in to take up that auction? And on average, it's about 2.5 times more demand for every new auction that the government is issuing. But what's more important is that the most recent auctions are above the historical average, which means that demand is not waning, the appetite is actually increasing. So until I see that waning, where it falls to like 2.4, 2.3, that's when I'll get more nervous. But right now, there is no waning of appetite when it comes to treasuries. And that's why I don't think that spike is going to be anytime soon.
Okay, we're going to get into the part of the show where we talk about the highest conviction areas of the market.
ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information.
Okay, the first area, I mean, you just said everybody's invested in tech and wants to be invested in tech. That includes Larry Adam. You're not turning your back on tech either.
That's one of my favorite sectors. And the reason for that, well, I'll tell you what my 3 favorite sectors are. They're technology, industrials, and healthcare. And what they all have in common is they are the areas that have the best earnings growth this year, 2025, and then once again next year in 2026. And as we started the show with, when valuations are elevated, the way you get stock prices higher is earnings growth. So those are the 3 areas that have the best earnings growth. What's going to drive those earnings? Well, when it comes to technology, I think it's the AI boom that we continue to be in. When it comes to the industrials, I think you're going to see sustained spending on defense. You know, now NATO's spending a lot more. So that's a global thing, not just a US thing. And you're going to continue to see the build out of infrastructure for AI. So that will continue to sustain that particular sector. And then when it comes to healthcare, it's the aging demographics around the globe, which means you need more healthcare needs. Again.
So healthcare is interesting because, as you know, parts of healthcare has underperformed. And healthcare, it can be anything. It can be insurers, it can be biotech, it can be some of those pharmaceuticals, it can be med tech. Do you get more granular than that within the healthcare that you think you're most optimistic on?
So to your point, healthcare, first of all, that underperformance has led to the most attractive valuations of any sector in the market. And one of the reasons for that is because of the cloud down in Washington about what was going to happen. And as you've seen, as a lot of those policies have come out, they've been a lot softer than what people thought, right, of their worst case scenarios. As far as the sector goes, one of the reasons why we like pretty much the entire sector is because it's a place you can be both offensive and defensive. So when you think defensive, you got those big pharmaceutical companies, right? Bigger dividends, maybe slightly lower growth rates, but they're going to continue just to be your steady eddies. But then you also have where you can be a little bit offensive, med devices, biotech, which I think will continue to do well, particularly as, again, using AI, they can kind of accelerate the whole production process of these new drugs. So that's an area that I think can be more offensive, if you will. And again, if you think the market's going to be a little bit more volatile here, I think that's an area because of those valuations that can continue to be a nice pillar in your portfolio.
You have to get those fund flows like off of AI, right? Like some of it is like the story is great, you know, low valuations, and maybe it's not going to be as penalized as much, but it's hard to maybe justify for your clients. I'm going to buy this instead of like what everyone is talking about.
Again, we believe in the I call them elegant, time-tested philosophies of asset allocation, and they are diversification, which is what you're getting to, rebalancing, and then the power of compounding, right? And when it comes to diversification, we're never going to be all in on a certain sector. We believe in the merits of diversification, and that's not only through the sectors of the equity market, it's also in the broader part, equities to fixed income to international to even some in commodities.
Larry, it has been an absolute pleasure. Thank you so much for joining me.
It's been my pleasure.
That's Larry Adam, the CIO of Raymond James. It's been so fun to be here in Vancouver. We'll catch you on the next episode.